Hey guys, today I'm going to explain the Greeks, which is an important element to options trading. Let's get started. There are 5 Greeks, and each has an important role in predicting price fluctuation. The 5 Greeks are delta, gamma, vega, theta, and rho. Let's begin with delta. Delta categorically tracks price. Delta has one of the biggest roles in options trading, especially if you're an option buyer. Delta identifies how much the option's price will change if the underlying stock moves $1. If an option has a delta of 0.30, every $1 the option rises, the premium will rise 30 cents. Conversely, if the stock drops $1 in value, the option will drop 30 cents in value. Option traders can use delta to speculate the probability of an option expiring in the money. An option with a 0.30 delta can be interpreted as having roughly a 30% chance of expiring in the money. Now I have to instill some caveats because although delta can be pretty accurate when predicting the chances of an option expiring in the money, it might be off due to implied volatility. If implied volatility is relatively normal, delta should be pretty accurate when tracking the chance of expiring in the money. Delta will change as the price of the underlying fluctuates. This change is due to the next Greek, gamma. Gamma is delta's partner. If an option has a delta of 0.30 and a gamma of 0.05, and the underlying goes up $1, then the premium will increase by 30 cents. Now, since gamma is 0.05, if the stock moves another $1 up, the premium will move 35 cents because you add delta and gamma together. If you didn't catch that, I'll give you one more detailed example. The stock is trading for $100 and you buy one call with a premium of $2.50. The delta is 0.30 and the gamma is 0.05. Now the stock goes up to $101. So your premium goes from $2.50 to $2.80 because the delta is 0.30. Now we add delta and gamma together to get 0.35. So now if the underlying goes up to $102, the premium will go up 35 cents. And now the premium will be $3.15. Now moving on to VEGA. VEGA oversees volatility. VEGA estimates how much the option's price will change with every 1% change in implied volatility. If you bought a call with a 0.04 VEGA and implied volatility moves up 1%, it is expected that your call will increase 4 cents in value. Implied volatility could rise dramatically due to earnings announcements, political reasons, or a number of different reasons. A rise in implied volatility can be a good or bad thing depending on your specific trade. The longer the contract is, the higher the VEGA will be as well. Now moving on to the last main Greek, which is theta. Theta measures the amount an option will decrease in value for every day that passes by. If you bought a call and the theta is 0.06, that option will lose 6 cents every day that passes by. Theta is an option seller's best friend and an option buyer's worst nightmare because it keeps chipping away at the premium's price. Now that the main Greeks are out of the way, let's talk about rho really quick, the less important of all the Greeks. Rho measures the rate of change on an option's price due to the change of interest rates. For example, if your option has a rho of 1.0, then every 1% increase in interest rates, the value of the option will increase by 1 cent. So that wraps it up for the Greeks. Make sure you like, comment, and subscribe if this helps. See you in my next video.